Hey everybody, welcome back to the Financial Freedom Show. My name's Rob Berger. Imagine you're about to retire and you're looking over your retirement accounts, and you have some in a taxable brokerage account, you have some in a tax-deferred account like a traditional IRA, and then you have some tax-free money in, say, a Roth IRA, and you're wondering, what order do you draw that down from? Do you start with one account type, and then when it runs out of money, go to the next, and then eventually the third? If so, what order? Or do you take from some combination of the three? And how in the world do we figure that out? So in today's video, we're going to first talk about the conventional, sort of traditional rule of thumb. And I'll tell you now, it's probably not the most tax efficient approach, frankly, for anybody. But it's actually a really good starting point, because I think looking at that rule of thumb, and we'll look at it in just a minute, it allows us to then make changes, modify the traditional rule of thumb in a way that will increase the tax efficiency of our withdrawal strategies. And that helps us increase the amount of after-tax money we have to spend in retirement. It can actually, research shows, increase the longevity of our portfolio. And of course, if it's important to you, it may increase the amount of after-tax money you leave to loved ones. So we're going to look at strategies we can use to improve the tax efficiency of our drawdown strategies. We'll talk about some issues and some gotchas, and they're out there. And then I'll also show you some tools you can use and some research. I've gone back all the way into the 90s. I'm not going to go through all of it, but I'll highlight a couple of articles that I think are particularly useful. So with that, let's start with the conventional strategy, and it's pretty straightforward. The conventional rule of thumb says spend all your taxable accounts first. Maybe you keep an emergency fund, but other than that, spend all your taxable money. Then spend all your tax-deferred accounts, your traditional IRAs, for example. And it's only then, when you've exhausted those two, that you turn to your tax-free money and start spending down your Roth. That's the conventional sort of wisdom. Now, if we followed that, what would our taxes look like over, say, a 30-year retirement? Well, it turns out we can look at that, and we're going to use New Retirement to do it. This is my favorite retirement planning software. It's what I personally use. We're looking at a demo version, and I've set this up. It's a retired couple, 65 and 68. I've got them living each 30 years. In terms of their assets, what I've done is put $500,000 in a traditional IRA, $500,000 in a Roth, and then $250,000 in a taxable brokerage account. So within New Retirement, we can go to Insights here down to Taxes. And this is where we can look. What I like to look at first is net taxable income by federal tax bracket, because this is truly a picture that's worth 1,000 words. You can see that in the first few years here, they're not paying any taxes, right? We can even come up here, gross taxable income by source, nothing, it's blank. Why is that? Well, they're not getting required minimum distributions. They're living largely off Social Security with some distributions for capital gains out of their taxable account, but it's not enough to trigger ordinary income tax once you factor in the deductions that they get, which today, under tax laws, it's almost 30 grand for a married couple. And so that basically eliminates all of their ordinary income tax. Now, they might pay a little bit of capital gains tax, and actually, we can look here, it doesn't look like they are. So, I mean, they've really, these first few years, pretty tax-free. Something happens in 2032 where they go into the 10% tax bracket, and you might guess it's required minimum distributions. Now, this is one thing we're going to have to keep in mind here as we walk through this. We're looking at tax brackets, and we think of our marginal tax bracket. What's the highest tax bracket that we're in a given year? If we go back here, their marginal tax bracket is 10%. In this year here, 2042, it's 15%. Eventually, as we can see here, it goes to 25%, again, in this hypothetical. But keep in mind that there are other complications with the tax code. Our income could cause us to end up paying more tax on our Social Security benefits, as I'm sure you know. It could cause us to pay higher premiums for Medicare. It could push our taxes on capital gains into higher capital gains tax brackets. So the taxable income that we generate from the decisions we make in retirement can affect a lot more than just our marginal tax brackets. And in fact, in the research, you'll see marginal tax brackets, but also marginal tax rates. And it's marginal tax rates that factor in all of these other things. But again, as a starting point, we can focus on the brackets. But the point is, when we go up here and we look at the sources of our income, and we'll start with 2032, you can see over here it's required minimum distributions, but it's also Social Security, because the required minimum distributions caused more of our Social Security to be taxed. It looks like none of it was taxed before 2032, right? So as we move forward in retirement, we move more and more into the 15% tax bracket. Of course, some of that is due to inflation and the adjustments to the tax brackets each year. But eventually, we also get into the 25% tax bracket. And so this is from the standard conventional wisdom, right, that's baked into new retirement. The good news is we can change this. We can change it in new retirement, and I'll show you how. But here's the basic idea. We'd like to take some of these higher tax years, particularly when we got into the 25% tax bracket, but maybe also when we're in that upper 15% tax bracket, and move it here. Let's take advantage of the zero taxes that we're paying. We might even be able to take advantage of some deductions that we're not fully taking advantage of in these early years. And then perhaps, let's just say, fill up the 10% tax bracket. And that might help us, just in that simple strategy, reduce our taxes, increase our after-tax spending, and even increase the longevity of our portfolio. So how do we go about doing it? Well, there are two basic ways. One is to draw from some traditional IRAs, and I'll show you how to do that in a minute. Well, we could, rather than spending all from our taxable accounts, we could say, you know what, let's draw down some of our traditional IRAs. And the research on this, and I'll show you some papers in a minute, generally say you could you can draw down your traditional IRAs at least to use up all of your standard deduction, or if you itemize, your itemized deductions. That just gets you to zero, right? So at least draw down enough of your traditional IRA to soak up the tax deductions that you get. Many of the papers go farther and say, you know, really, you could fill up the first or second tax brackets. The first tax bracket would be 10%. Again, we're talking federal. The second tax bracket currently is 12. Now, if tax laws don't change, it's going to revert to 15% in 2026. And before the current tax laws, we go back to 2017, it was 15%. I mention that in part because if you read some of the research I'm going to show you, some of it is before the 2017 tax laws, so they refer to the 15% tax bracket. But of course, as we know now, at the moment, it's 12%. But the idea is, depending on how high your taxes will go later in your retirement, when you're getting Social Security and required minimum distributions kick in, you might want to fill up the 10% tax bracket, maybe even, I'll call it the 12/15% tax bracket. And for those with a significant amount of money, you might even go higher than that, but for all our purposes, we'll stay within that range. So going back to the tool, how might that work? Well, we can come back here to money flows, and what we'll do is we could do a Roth conversion. Now, I mentioned we could take from a traditional IRA. The second strategy is to do Roth conversions. I will tell you that the research I have read tells me, and this surprised me, that while there can be a slight advantage to doing the Roth conversion approach rather than simply drawing down traditional IRAs and spending the money, the advantage is not as significant as I thought, and it does add complications because with taking the IRA withdrawals, you're spending that money, you're perhaps paying the taxes in part from that money or money you pull from a taxable account. But with Roth conversions, of course, you've got to execute the Roth conversion. Not that difficult, but it's something you have to do. And then you're not actually accessing any of that money, so the taxes from that are going to have to be paid from another source. Again, the research tells me there's a slight advantage to doing that over simply distributing, taking traditional IRA distributions. I was surprised to see, though, that the advantages weren't nearly as significant as I thought. Obviously, you'll decide what you think is best for you. For our purposes, we're just going to do a transfer. So effectively what this would do, we're going to transfer money from the traditional retirement account to the brokerage account. And remember, new retirement is designed to spend the brokerage account first, and that's what we want here. That's why we're going to move some traditional IRA money over to the brokerage account. Let's start with $20,000. And we're going to do it this year. We'll just set it for March. Now, what we want to do is keep an eye on how this affects both our estimated taxes here and our net income. This is by state. Actually, I'm going to come down here. Let's focus on the net taxable income by federal tax bracket. So if I save this, you might have seen just a slight decrease for actually all of the bars, but nothing here. We still hadn't taken enough money out to actually trigger taxes. That's a good problem, right? Fair enough. Let's go to 30,000. And we start to see we have used up some of the 10% bracket. I don't know if you noticed, but some of this went down as well. We could adjust this further. I think we cap out somewhere around 35,000 with the numbers I've put into this system. So yeah, it brings up this, not quite to the top of the 10% tax bracket, but very close. And it lowers this. And you can see we lowered just from that one change, we lowered this 25% bracket pretty significantly. In fact, I wonder if we add another transfer, we'll go to the brokerage account. Let's just do the same amount. But in this case, we want to do it the next tax year. We don't want to do it this year. We'll do it in 25. Yeah, so you can see we've increased it here. We could probably increase it a little more. And we've almost gotten rid of all of our income that would be subject to the 25% tax bracket at the end of our plan. Probably one more transfer or increasing this transfer would have done it. And that's one of the things I like about new retirement is you get this visual feedback as you make changes. Again, I showed you the approach of transferring that money into a brokerage account. Of course, you have to pay the taxes on it, and then you'd spend it as part of your plan. Again, once you got to that, say, in this case, the top of the 10% bracket, if you still needed more money, you typically take from the taxable account in the research that I have read. However, I want to show you a research paper that I highly recommend you read if this is of interest to you. It was actually put out by T. Rowe Price. And one of the things they say, they give you a number of different examples. It's easy to follow. And they give you colorful charts like this, so I like it a lot. This is what they showed was a simple example using the conventional wisdom, the one I described. But what I found interesting in this example is they were filling up the 10% tax bracket, similar to what I showed you. So that's why you see even in year one of retirement, the blue line is Social Security. The green line is taxable accounts, but the orange line is tax deferred, traditional 401 IRA or 401k. So they're right from year one. They're taking money out of traditional retirement accounts, just like I showed you in new retirement, in order to take advantage of those low tax rates. But the thing I want to point out is the yellow. Notice the yellow in this chart. It represents distributions from a Roth IRA. And notice they're starting it as early as year 7. When there's still taxable account. I think they liquidated all of the taxable accounts that year. But notice there's still tax deferred money. That's the orange bar. And in fact, tax deferred money is even here at the end of the plan. Very different than conventional wisdom that says spend all your tax deferred first before you touch your Roth. Shouldn't we hold on to Roth accounts for as long as possible? Well, not according to T. Rowe Price. Well, why is that? Well, remember we talked about the difference between marginal tax brackets and marginal tax rates. Sometimes we can strategically use distributions from a Roth account in order to keep our taxable income at a level that doesn't trigger those other adverse consequences, like moving our long-term capital gains from the 0% rate up to 15%, or causing more of our Social Security benefits to be taxed, or perhaps triggering another level of IRMA, which dictates higher premiums for Medicare. So in this case, T. Rowe Price is saying, hey, let's use the Roth funds that we have strategically to sort of stay out of those thorny tax problems that increase our taxes even beyond what our tax brackets would suggest. And in fact, they were able to eliminate taxes. The taxes in this chart are this dark blue at the bottom. They only come up at the end. Now, one other interesting thing that I've seen recommended several times. You'll notice in this scenario, there's still a lot of tax deferred traditional IRAs at the end of the plan, and they're using them. So one of the strategies that I've seen a number of papers suggest is this. hold on to some amount of your tax-deferred dollars until later in life. Why? Because later in life, we're likely to need a lot of medical care. It's just a fact of life. And over a certain amount, of course, medical expenses are deductible. And so if you end up in some sort of care facility that you're self-funding and you're spending a lot of your money for healthcare, and it can get significant in the last few years of life, if we say live into our 80s or 90s, you could actually benefit in those years from drawing down tax-deferred or traditional IRA money. Yes, it's going to be taxed as ordinary income, but you may have very large write-offs for all of those medical expenses that you're incurring. Again, I'm not suggesting that everyone should necessarily plan for that outcome. We all have to make our individual choices in that regard, but I do think it's something worth keeping in mind. All right, so we understand the conventional rule. We understand why it's usually not optimal. We can see graphically, as I showed you, I'll move back to it, with new retirement, how we can, through either spending traditional IRA money up to a certain tax bracket, we use 10% in our example, we can generate some taxable income here. Yeah, not normally a good thing, but it's only at 10%, the 10% bracket, and it helps us save a lot of money later in life. We can, as I mentioned, use Roth conversions instead, or in combination with spending traditional IRA money. And then, as we saw from the T. Rowe Price article, here it is, we can use some Roth money as needed to keep other things from causing us to spend more money, like tax on Social Security benefits or a higher capital gains, long-term capital gains tax rate. So I highly recommend this paper, and I highly recommend this paper. This is the effects of Social Security benefits and RMDs on tax-efficient withdrawal strategies. I would say this paper is a little more technical than the first one, but the reason I would suggest this paper is for those that really want to understand the effects of Social Security taxes and the impact RMDs can have on those Social Security taxes as well as other income. That paper goes into a lot of detail on those. And even though some of these papers are older and some of the tax laws may have changed, some talk about recharacterizing a Roth IRA conversion, for example, which you can no longer do, I think you can still learn a lot from them. Now, let me show you one other resource on research, then we'll look at a tool in addition to new retirement, and then I'll bring this video to an end, which I'm sure you'll all be thankful for. All right, I am starting to create an archive of all of the research that I read. I mentioned in the last live Q&A, I have this tools directory. We've got 20 tools in there now. I've got at least a dozen more that are ready to be published. You can search by the type of tool. You can search by the features. You want to say, oh, I want to track my dividends. Which tools do that? Boom, there you go. I'm doing the same thing with all of the research papers. Let me go back to it. Maybe, here it is. I've only got, 8 or 9 in there at the moment, maybe a few more. But you can search by topic. And I've got literally hundreds of research papers that I have in my files. And I'm slowly publishing them to my website. Where for each one, you can take a look at it. I give a sort of a one-sentence summary. I give it my own rating, a brief summary, if there's charts, and of course a link so you can go to the source itself. And if we go back to the research page, you can select by topic. I'll be adding more topics, but if we go to withdrawal order, you can see I've already got, 6, 7 papers in there. We've only looked at a couple of them. So hopefully this resource will be helpful to you. I will leave links to it below the video. So what's the other tool that I want to mention? And it's called ORP, Optimal Retirement Planner. Here it is. It is not a pretty tool, but it is an interesting tool. It's free. And in my mind, this is the kind of tool that I would use in conjunction with a tool like New Retirement, because you may be looking at this and saying, Rob, I appreciate that you did that, but man, this just seems overwhelming. Where do I even start? And Optimal Retirement Planner may give you some guidance in that regard. Now, I put in a couple that's both 65. They've each got 250,000. They put this, it's in thousands, so you put 250 for 250,000. They each have 150,000 in Roths. They have 250,000 in a brokerage. There are a lot more factors I could put in. I could include contributions to each of these accounts if you're not retired yet. You can do illiquid assets like a mortgage, a loan. You can model a reverse mortgage. There's various guaranteed income. I've put a little bit in for Social Security, but you can put in pensions and other things. You can also model the taxable income limit for the ACA, premium tax credit. You can also model Roth conversions. In fact, let's do that. Let's just assume we want to convert up to, we'll say the 12% tax bracket. Just picking one. You can set your inflation rate. So there's a lot of detail you can go into. But we'll just run it like this. See if this works. Here we go. And it takes some time to understand these results. All of these terms, if you scroll, I'm going to scroll all the way to the bottom, then we'll go back to the top for a second. They're all defined here. I think most of them are. Yeah. So, and you can download this spreadsheet. You can also save this number or combination of numbers and letters to go back to a plan later if you want to. But if we go back to the top, I'm not going to walk through each one of these, but it just gives you a rough idea. Here's a nominal, I mean without regard to inflation, a nominal withdrawal report. And it says, okay, your RMDs, of course, they're 65, so at the present there aren't any, right? They don't kick in until 72, I guess, or even 73, eventually 75. It's going to change in 9 years. But so RMD column, tax deferred, so this would be a traditional. So what this tool is saying for what it views to be the most tax efficient approach, you should take out $38,000 from traditional IRA. You should take out $62,000 from taxable. You should do an IRA to Roth conversion of $38,000. Of course, you're going to pay some taxes on that. The yield comes off the taxable account, and the taxes, according to this, $2,000. And this goes year by year. And it tells you, again, which accounts do you draw from. Eventually, notice this is having you draw from your first Roth IRA withdrawal at age 69 while you still have plenty of tax-deferred money. So this is certainly not following the conventional wisdom. But at this point, what you have done is run out of after-tax money. It has depleted the $250,000 that we set up in taxable income. So the one thing I would say about this tool is use it, but use it very critically. I mean, use it and question everything. That's why I personally will use it in conjunction with new retirement because you want to make sure you have some sense as to why these numbers make sense, if they make sense for you. The other thing I'll mention that I didn't do here is set spending, but you can set your spending both essential and what they call extraordinary or one-time events, non-recurring events, and when they're going to happen right here. So I think the Optimal Retirement Planner is an interesting tool to explore. Again, I wouldn't take the results as gospel. I'm going to use them in the context of new retirement to model out a plan year by year and come up with what I think is a reasonably tax efficient plan. I'm not going to try to find the best because there's no way to do that, right? Tax laws change. We don't know what those changes are going to be in many cases. Our balances will change. In fact, let me just show you this. In this tax scenario, I've been assuming an optimistic rate of return, which in the case of this plan was 9%. But if we go to the federal income tax brackets and I change this to average return, it changed the bars. I don't know if you saw it, but they went down. And in fact, we got rid of our 28% or 25% tax bracket because our traditional IRAs don't have as much money in them as they did when we had optimistic, and there they are. There's the 25% back. The point being, assumptions matter, and they matter whether you're using new retirement, Optimal Retirement Planner that I showed you, or some other tool. And so this is going to be an ongoing process, probably do an analysis every single year. Anyway, I hope that helps. I will leave links to the research page on my website and the tools page. From the research page, you can find all of the research, the two papers that I showed you that I think are particularly interesting, but as well as others as well on this question of withdrawal order. And hopefully this has been helpful to you. Please do leave any thoughts or questions you have in the comments below. I will be the first person. This is frankly, I think, of all of the subjects I've tried to cover on this channel, this is one that is probably the most complicated in theory. And you can really dive into the weeds. At the end of the day, I think you can just focus on sort of the low-hanging fruit, taking advantage of those lower tax brackets in early retirement, particularly certainly before RMDs kick in and even before Social Security benefits kick in if you can. Taking advantage of those low tax brackets probably gives you the biggest bang for your buck in terms of trying to optimize tax efficiencies with perhaps some strategic Roth IRA distributions just to stay away from those higher capital gains tax rates or perhaps more tax on your Social Security benefits. And of course, if a big part of your plan is leaving money to loved ones, you do want to consider their tax rates. Would they be better off receiving Roth money or tax-deferred money? And would you be better off spending one or the other? Sometimes an analysis of their tax situation can be beneficial as well. Well, there you go. Hope this has been helpful. Like I said, leave comments below and I'll do my best to help you out any way I can. And until next time, remember, the best thing money can buy is financial freedom.